But one of the things I do focus on is the nuance of low risk and high uncertainty. So basically, the thing is that stock markets hate uncertainty. So what they want is you produced $1 in earnings this year, please produce $1.10 next year, $1.20 2 years from now, $1.35 3 years from now, and please go nonstop like that. Okay? And the reality is that the business world is very messy. It just doesn't work that way. You know, things just don't go in a straight line, and they go up and down and such. So stock markets have, in my opinion, a irrational, extreme expectation of smoothness in business operations, and almost any business is anything but smooth. And so if a business has a temporary hiccup, you know, they just say, hey, by the way, next quarter might be slightly off, taken out back and shot. First, let's take it out back and shoot it, then we'll ask questions. Okay? Buffett had mentioned that when he was buying the Washington Post, I think the market cap of the company was around $80 million. And he said in any private transaction then, it would have sold for $400 million. So it was sitting at about 1/5 of liquidation value or the sale of a private, what a private buyer would pay. And the 80 million market cap went down to 60 million because people just kept selling the stock. And the sellers, and Warren knew some of the sellers, they agreed with him that the private market value was 400 million. But they just didn't want to deal with the near-term uncertainty that the business was facing. So if you have a business which exhibits very high uncertainty, then that business generally will get very extreme kind of valuations in a auction-driven market. And an investor can take advantage of it because markets get confused between risk and uncertainty. They get confused between these two.